Now it's your turn. I'd like to give you some practice with these adjusting entries. I'm going to present you with the transaction, give you a few moments to take a look at it and work through it, and then come back and see how you do. As you're going through these, keep in mind that you're thinking about deferred revenues, deferred expenses, accrued revenues, or accrued expenses. And that might help you think about how to record each of these. And of course, while you're doing this, I'll be right there with you. I know there's a lot of vegetables to be eaten. I'll go to the beets now. Phew. Okay, first one. On January 1st, a publisher receives $30 in cash from an individual for a 3-year magazine subscription. What entries is that publisher going to record? Let's think about two different things. The entry that gets recorded when the subscription is purchased on January 1st, and then the entry that gets recorded on December 31st as an adjusting entry. Take a few minutes, give it a shot, then come back and we'll see how it went. How did it go? I bet you were able to tackle this one. Let's take a look. When the subscription is purchased on January 1, the company receives cash from the individual for the magazine subscription. The simple receipt of the cash means a transaction has occurred and something needs to be recorded in the books. Recall from our tutorial that we would record an increase in cash, which is an asset, so it would be a left side entry in the journal entry, for $30 because that's how much cash was received. But the company can't yet record that as revenue because it hasn't yet earned the revenue. It won't earn the revenue until it's actually provided the magazines to the individual customer. Now it has a liability or an obligation to provide those magazines because the customer has given cash to the publisher. So we'll record that liability as a deferred revenue for the entire $30. Then as the company provides magazines to the customer, the company will be able to record the revenue because it will have been earned. So on December 31st, at the end of the first year, we'll record an adjusting entry. Now remember, at the end of the first year, the company will have provided some magazines to the customer that the company will have provided some magazines to the customer and will be entitled to record the earned portion of the revenue as revenue. And since we had a $30 subscription that was 3 years, the simple math tells us that each year is about $10, so the company's entitled to record that $10 in revenue at the end of the first year. So it would record the revenue as the right-hand side to retained earnings, and then the left-hand side would be a reduction in the deferred revenue liability. Okay, let's go to the next one. On November 30th, XYZ Company pays its landlord $4,000 for December rent. What entries does XYZ Company record in its books? Let's think about them in terms of two entries. When the payment is made on November 30th, and then second, on December 31st, the adjusting entry that would be recorded. Take a few minutes, give it a try, then come on back and we'll see how it went. How did it go? Let's take a look. When the payment is made on November 30th, the company has an outflow of cash, so certainly something would need to be recorded at that point in time. So we're going to see the reduction in cash on the right-hand side of the entry, and the company has essentially purchased an asset. It's paid its rent in advance. And so we're going to record this asset account as a left-hand side entry or a debit in the journal entry. And we'll call it prepaid rent. We might call it rent paid in advance or rent paid to the landlord before we've used the building. But importantly, it's an asset and it's related to rent. On December 31st, the XYZ Company has made use of the building, and at that point in time, it would need to record an expense. So it would record its left-hand side entry to retained earnings for its rent expense and a right-hand side entry to reduce the asset account, and we're recording the expense to reflect the usage of that asset. Now remember the matching principle. This is key in this particular instance. The matching principle again tells us that anytime we record revenues, for this year in particular, anytime we record revenues, we need to find all the costs that the company has incurred to generate those revenues, and they have to be recorded as an expense at the same time we're recording the revenues, so that we have our expenses matched to the revenues they helped us to generate. That's the fundamental nature of accrual accounting, and that's indeed why we're having to record this adjusting entry. So you might recognize this not as a deferred revenue, which we just previously saw in the first practice transaction, but this one is a deferred expense or a prepaid expense. Okay, let's move to the next one. On January 1st, STR Company buys some equipment that cost $100,000. They think they're going to be able to use it for 5 years, at which point in time it's not going to be worth anything at that point. What entries does the company need to record? Let's think about these again in 2 entries. When the equipment is purchased on January 1st, and then second, on December 31st, the adjusting entry. Take a few minutes, give it a try, then come back and we'll see how it went. Okay, let's take a look. When the equipment is purchased on January 1st, very similar to the prior transaction, we see an outflow of cash, and so we have a reduction to cash on the right-hand side of the journal entry for the entire $100,000 cost. And we have an increase in the asset account that we'll call equipment, or property, plant, and equipment, something of that nature, but importantly, it's an asset account, and that increases. Now, as we use that asset to help us generate revenues, remember, the matching principle is going to tell us that we need to record the cost of using that asset as an expense, so that we would be matching the expense associated with the asset to the revenues it's helping us generate. So as an adjusting entry on December 31st, we would need to record a reduction in the asset account to reflect that we've been using the asset, and we'll record a left-hand side to retained earnings for an expense. And this expense we'll call depreciation expense. It's a fancy name that accountants give this expense, but it is essentially the result of matching the cost of using the asset to the revenues that asset has helped us generate. And here we've got a left hand and a right hand for $20,000. How did we get that $20,000? I'm curious to know if that's the number that you came up with, and it'd be interesting to know the logic behind this $20,000. We have $100,000 that we've spent on this asset. The company estimates that it will use that equipment for 5 years. So the cost of that equipment will be allocated over all 5 of those years because it will be helping to generate revenues in each of those years. There are many different ways that companies can use to allocate that cost. I've just simply taken the $100,000 and divided by the 5 years and just have suggested that we allocate an equal portion to each of those 5 years, and so the current year would be allocated $20,000. There are other more sophisticated ways to do that we won't worry about at the moment. The important point is knowing that we need to record the expense. Now, one other thing I'm going to point out here is that we had talked previously about with deferred revenues and deferred expenses, the cash effect happens first and the adjusting entry is recorded later. And so what we're seeing here is that when the equipment was purchased, the cash effect occurred, and then the expense that's recorded at later dates is a result of accrual accounting and the matching principle. Let's try another one. On December 31st, JKL Company determines that it owes income tax of $10,000 for the fiscal year. It's going to pay that bill the following April 15th, but the $10,000 is related to the year that ends December 31st. What entry is JKL Company going to record? Again, 2 parts, the adjusting entry on December 31st and when the payment is made on April 15th. Take a few minutes, give it a try, and then come back and let's see how you did. And I'm realizing that this is a lot like vegetables, and I haven't been eating mine. So while you're gone to work on this one, I'll take another bite of this beet. So, how did it go? My beet was very good. I hope you enjoyed yours as well. Let's take a look and see how it went. Okay, on December 31st, we're going to record an adjusting entry. We're going to record an expense, so we'd have a left-hand side to retained earnings with a notation of income tax expense. And since we haven't yet paid the bill in cash, we have an obligation to pay it, but we haven't yet paid it, we're recording a right-hand side or a credit to a liability account. We can call that income taxes that we have to pay in the future for this year's income tax, or we can call it income tax payable or income tax that we owe to the government, but importantly, it's a liability. Right-hand side to a liability, so we're increasing that by $10,000. Now remember, the matching principle again tells us that we have to take the expenses we've incurred the current year when we've been generating the current year's revenues and record them this year to match them to this year's revenues. That's exactly what we're doing here with this entry. When April 15th arrives, the company makes payment. At that point in time, the liability has been satisfied by the payment of cash, so we reduce the liability, a left-hand side or debit, and we reduce the cash balance by $10,000. Now notice this is a bit different than the three transactions we've recorded previously. You might notice that in this example, we've recorded the adjusting entry first, and we've recorded the entry where the cash effect occurs later. Recall that with deferred revenues and expenses, the cash effect occurs first, and then the adjusting entry occurs. But with accrued revenues and accrued expenses, the revenue and the expense are recorded first, and the cash effect occurs in the future. So here we have the cash effect occurring in the future. So this would be an accrued expense, and we're accruing the expense by recording it here with a corresponding liability associated with it. I think we're on a roll here. Let's try another one. Okay. GHI Company leases a building to JKL Company for $3,000 per month. GHI receives the rent payment, the $3,000 for each month, at the beginning of the following month. What entries does GHI Company record related to the rent for the month of December? We're going to see an adjusting entry on December 31st of the current year, and then we'll see another entry when payment is made in January of the following year. Take a few minutes, give it a try, then come back and we'll see how you did. Okay, how did it go? I think you might be getting the hang of this. On December 31st, as an adjusting entry, GHI Company has provided the use of the building to another company for the month of December. Now remember, we can record revenue or recognize revenue when we have completed the transaction or provided the service and that collectability of the cash is reasonably assured. Well, in this case, GHI has provided use of the building to the other company for the month of December. So it's completed providing the service for that month. And collectability is reasonably assured, we're assuming, probably because they have an ongoing relationship and JKL routinely pays its bills. So in this case, the company, GHI Company, can go ahead and record revenues for the month of December in the amount of $3,000. But notice that it hasn't received any cash. So recall, in this situation, when we're recording revenues but we haven't received any cash, we'll record an asset called a receivable. And I've called that rent receivable, but we could call it rent that we expect to receive from the tenant in the future. But importantly, it's an asset, and we're expecting to receive payment. And then when the payment is received in January, GHI Company would record the receipt of the cash by making the left-hand side entry or debit to cash, and they would reduce the rent receivable asset account because they no longer need that on the books because they have received the cash. Notice again that we're looking at accrued revenues. Similar to looking at accrued expenses in the prior transaction, the cash effect is occurring at some point in the future, but the revenue is being recorded as an adjusting entry in the current accounting period.